Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. So if you're looking for that really essential summary of where the money's moving, what narratives are actually driving the markets this week, well, you've definitely come to the right place. Today's deep dive is for you. We're synthesizing the big financial and business headlines from key sources, think Yahoo Finance, CNBC, Reuters, Bloomberg, kicking off this trading week, November 3rd, 2025.
Yeah, our mission today is really to track these two huge, sometimes, contradictory forces shaping things right now. First, we're following the money, seeing how this AI euphoria is spilling pretty dramatically out of just big tech and into the physical world, the real economy, so to speak.
Right.
And second, there's this really complex web of policy and politics. You've got evolving global trade tariffs, plus some serious domestic turbulence with the ongoing government shutdown.
Okay, let's start with that AI story then, because the momentum, well, it's been spectacular, hasn't it? We know the S&P 500 is up 17% year to date. The NASDAQ jumped almost 5% just in October. And this is almost entirely driven by this huge investment cycle in artificial intelligence.
Absolutely. And we saw NVIDIA, the sort of poster child for this, hit that incredible $5 trillion valuation recently. Their CEO, Jensen Huang, he famously calls it a virtuous cycle, right? Where usage drives investment. Investment makes the AI better, which, boosts usage even more. But what's really fascinating now, I think, is the shift in where that investment is going. It's not just about designing the chips anymore. It's about the underlying infrastructure you need to actually run all this stuff.
And this is where it gets really interesting for you, the listener, because this AI boom has suddenly made, well, America's old guard industrial companies incredibly strategic.
Right.
We're talking huge capital spending flowing into, concrete, steel, and power.
Exactly. Look at Caterpillar, CIT. Their stock jumped, 11% after really strong Q3 results?
Yeah, Yahoo Finance covered how these industrial giants are suddenly benefiting from AI. Caterpillar reported adjusted earnings per share of $4.95. That comfortably beat the $4.52 analysts expected.
But the key surprise, the really interesting bit, was what they were selling. The biggest jump wasn't in, excavators or their usual construction gear.
No.
It was power generation machinery. That soared 33% year over year.
And that 33% jump, that's really the core insight for you because it signals this fundamental stress point in the whole AI economy. These massive data centers, they just need immense reliable power. And they're completely straining the existing U.S. power grid. So when the grid can't handle it, what happens?
Well, they build their own power source. You see developers like Meta, for example, down in places like Richland Parish, Louisiana. They're building their own on-site natural gas turbines just to handle their computing loads.
Right.
And that is precisely Caterpillar's bread and butter. Their CEO, Joe Creed, he confirmed they are in the early stages of the prime power opportunities. They see huge confidence in that project pipeline going forward.
And it's not just Caterpillar, right? Which proves this isn't some one-off event. Honeywell, another big industrial, cited data center demand as a significant bright spot in their strong Q3 earnings, too.
Yeah, and even the power utilities themselves, like NextEra Energy, they noted that what they call hyperscalers, the huge cloud companies like Microsoft, Amazon, Google, they need solutions for these massive electricity loads, not just today, but today and tomorrow.
So the immediate demand is for the turbines, the physical power generation. But that has this ripple effect, a systemic impact on how big tech actually operates.
Definitely. If you look at the strategy coming out of Microsoft, for instance, CEO Satya Nadella mentioned that while their headcount will keep growing, it'll be done with a lot more leverage, basically thanks to AI tools.
So if I'm connecting the dots here for you, you've got Caterpillar supplying the physical power and Microsoft using AI to supply digital leverage. The industrial side benefits from building the machine,
right?
While big tech benefits from more efficiency inside the machine, which means, as Nadella said, their employees have to kind of unlearn and relearn how they work. It's a total reshaping of both capital spending and, well, human capital.
Precisely. It's a huge shift.
Right.
But now we kind of have to pivot from that economic boom story to the geopolitical tension, which is frankly setting up some pretty significant barriers to all that growth.
Okay, yeah, let's move to geopolitics. Because it's been a really contradictory news cycle this past week. We had that high-stakes meeting between President Trump and President Xi Jinping in South Korea. And the first reports, they really focused on a trade truce, a thaw.
The initial details certainly sounded like a thaw, yeah. As reported by CNBC and Yahoo Finance, The U.S. agreed to lower some fentanyl-related tariffs on Chinese goods. That brought the overall U.S. tariff rate on Chinese imports down from about 57% to around 47%.
Okay.
And China, for its part, paused some extra export controls they had planned on rare earth metals just for 1 year, though. And they committed to start buying, quote, tremendous amounts of U.S. soybeans again.
Which, seemed like a major de-escalation for global trade. But then, almost immediately afterward, the really big news dropped, and it completely undercut that whole truce narrative.
That's the critical point. That's the friction that really defines the U.S. strategic priority right now. Despite the broader trade deal, President Trump announced that the most advanced NVIDIA Blackwell chips, they're going to be reserved exclusively for U.S. customers,
Wow.
barred from export to China, and importantly, other countries too. So the U.S. is basically saying, look, we'll trade soybeans, maybe fiddle with some regulatory credits, but we are drawing a very firm line around the core technology for future AI dominance.
And just as the U.S. was slightly, lowering the tariff rate on China, we saw this massive kind of unexpected shift in how another key strategic partner is being treated.
Right, India. CNBC reported that India now actually incurs a higher total U.S. tariff rate, 50%, than China's 47%.
50%. That's higher than China.
Higher than China now, yeah. And this is more than just a number. It's being read as a major geopolitical signal. Experts are interpreting this as a clear sign that the relationship between the U.S. and India is becoming really purely transactional.
Which could backfire.
Well, the serious worry among policy analysts is exactly that this disconnect plus the higher tariffs could end up pushing India further towards, competing powers. Maybe Russia, maybe China. It's a risk.
And back home, these tariffs, they continue to be a drag, right? Especially on the consumer. LendingTree estimates the total impact of tariffs will add over $40 billion to holiday shopping costs this year.
Yeah, that breaks down to about, $132 per average shopper. And electronics buyers get hit the hardest, something like $186 extra per person. That's coming from CNBC.
Ouch. But there are complexities even within that, right? Especially in certain sectors, like autos.
Exactly. In the auto sector, CNN reported on this. Big car makers like Ford, GM, they initially feared the tariffs would cause billions in damage. But those cost estimates ended up being significantly reduced.
And the reason why is fascinating because it shows how interconnected trade policy is with, domestic regulation.
Totally. A huge financial offset for the automakers was the elimination of penalties for violating emission standards. Ford, for instance, was apparently saved an estimated $2.5 billion they were planning to spend on regulatory credits.
So that policy relief essentially canceled out the tariff hit, changed the whole financial picture for them.
It did. And one final sort of immediate trade story to watch. The Supreme Court is scheduled to hear arguments this week on the legality of President Trump's broadest global tariffs.
Is he going?
Well, he indicated he plans to skip the hearing, which is notable because if he had attended, he would have been the first sitting president ever to appear at SCOTUS oral argument.
Interesting. Okay, let's shift to the macro and policy picture here in the U.S. The government shutdown, that remains the biggest source of domestic drag, right?
Yeah, it's now entering its 4th week, and it's officially on track to surpass 35 days, which, would make it the longest government shutdown in U.S. history.
And the immediate economic impact for you, the investor, is this data vacuum it creates.
Precisely. The shutdown keeps delaying key reports. We still don't have the official monthly jobs report, so investors are going to be leaning really heavily on the ADP private payrolls report this Wednesday, just looking for any clue about the labor market's health.
Did get a bit of news on essential services, though. Treasury Secretary Scott Bessent announced that SNF food benefits, that's aid for about 42 million Americans, could actually restart by Wednesday.
That's following some federal judicial rulings basically mandating the use of emergency funds to pay them out. So some relief there, potentially.
And Secretary Bessent, he's also been a pretty major voice trying to influence Fed policy discussions lately.
He has. The Fed did cut rates by a 1/4 point last week, but the internal disagreement was, palpable. You had one governor wanting a bigger 50 basis point cut and another wanting no change at all. Suggests real division there.
And Bessent himself has been pretty vocal, repeating his call for faster rate cuts. Reuters reported he's arguing that these high U.S. interest rates might have already pushed some parts of the economy, especially housing, into a recession.
Yeah, that's his view. Meanwhile, the bond market's kind of reflecting all this uncertainty. Treasury yields ticked a bit lower on Monday. The benchmark 10-year yield is hovering just over 4%.
Okay, let's turn to the other big macro signal, oil. What's happening there?
Well, OPEC Plus decided to pause their planned output hikes for the next quarter. That signals they expect demand to slow down seasonally. Brent crude, the international benchmark, is trading below $65 a barrel right now.
But the longer-term issue, the thing keeping a lid on prices, is this projected oversupply, right? The oil glut.
That's the core structural problem. The surplus is currently around 1.9 million barrels per day. But the International Energy Agency, they project this could become untenable. They're worried maybe 4 million barrels per day through 2026 if nothing changes fundamentally. That's a huge headwind for oil prices long term.
But that forecast depends heavily on geopolitics, doesn't it?
Oh, absolutely. That supply forecast is only as solid as the geopolitical situation allows. The major wild card, the swing factor, is really the U.S. sanctions on Russian oil firms, Rosneft, Lukoil.
How much impact did that have?
It really depends on severity. If the sanctions are moderate, maybe cutting 500,000 to 600,000 barrels per day from Russian supply, then yeah, the glut story probably holds and Brent could maybe drift down towards $56.
But if they're tough?
But if the sanctions are severe, say they cut closer to 1.5 million barrels per day, then you could see prices spike temporarily, maybe above $84, before settling much higher. So those sanctions, they are the single biggest variable to watch in the oil market right now.
Okay, that's a really comprehensive look at the immediate drivers. So looking beyond just this week's numbers and policy fights, let's touch briefly on maybe two really big forward-looking trends that are set to reshape things, the future of finance and the future of healthcare.
Sure. On the finance front, Standard Chartered CEO Bill Winters made a really bold prediction at Hong Kong FinTech Week recently. He basically said he believes pretty much all transactions will settle on blockchains eventually, and that all money will be digital.
Wow. All transaction.
Pretty much all, yeah. He sees it as a complete rewiring of the financial system, according to CNBC. And this whole idea of tokenization, where you track real-world assets and money digitally on a distributed ledger, it's already being tested. Hong Kong specifically is working towards a Hong Kong dollar-backed stablecoin.
That really changes the entire back-end plumbing of banking, doesn't it?
Completely.
Okay, shifting gears then to healthcare. We need to talk about this massive rivalry driving the weight loss drug market. It's on track to be, what, a $100 billion industry by 2030?
Easily. And the current battleground is over these injectable GLP-1 drugs, the ones that treat obesity and diabetes like Ozempic and Mounjaro. Right now, Eli Lilly seems to have pulled ahead of Novo Nordisk. They've apparently secured about 57% of the market share for the injectables.
Why is that?
It's largely attributed to what clinical trials suggest is superior efficacy and maybe better tolerability for their injections. That's based on the CNBC report.
But the next big fight is about convenience, right? Pills instead of shots.
Exactly. The next phase everyone's watching is the oral pills. You've got Novo Nordisk's oral semaglutide competing against Eli Lilly's orforglipron. Forecasts are suggesting these daily pills could capture maybe 24% of that huge market by 2030.
But there's still big questions.
Huge questions. Will they actually be as effective as the injections? How well will people tolerate them day to day? And critically, how are they going to price these things compared to the already expensive injections? That pricing strategy is key.
Fascinating market to watch. And finally, maybe let's look beyond markets for a second to the more philosophical side of AI that we're already starting to debate.
Yeah, it's pretty deep stuff. Microsoft's AI CEO, Mustafa Suleyman, he's wading right into the consciousness debate. He's arguing pretty strongly, actually, that consciousness, true consciousness, can likely only happen in biological beings.
So what's his argument against conscious AI or AGI?
Well, what's interesting is he says pursuing seemingly conscious AI, trying to build AGI, is actually the wrong question to be asking.
Oh.
He emphasizes that these AI models, they only create the perception of experience, or maybe pain, through really sophisticated mimicry.
Not the real thing.
Not the genuine biological reality of consciousness in his view. So that kind of shifts the focus, doesn't it?
Yeah.
Away from trying to achieve machine sentience and more towards controlling an increasingly powerful but ultimately non-conscious tool.
Okay, so let's try and bring this all together for you, the listener. This week seems defined by these massive interconnected forces, right? You've got the huge infrastructure needed for the AI boom, the turbines, the power grid upgrades.
Yeah.
But that's clashing directly with this really complex, almost transactional global tariff environment.
Right. And all of that is playing out against this backdrop of macro uncertainty, driven largely by what's now the longest government shutdown in U.S. history and a pretty divided Federal Reserve.
Indeed. And it's interesting, we spent a lot of time today focusing on the hardware, the physical stuff needed for AI, but maybe the political economy of AI is already the more immediate disruptive force.
I think that's right. I mean, look at the timing. The U.S. bars China from getting the absolute top-tier NVIDIA chips literally right after signing what looked like a major trade truce.
Yeah, that action forces this global question for basically every major company and every non-US government. And this is the thought we want to leave you with this morning. How will this immediate AI Cold War restriction reshape global tech investment outside of the US?
If you're a country or a corporation and you absolutely need cutting-edge AI, but you're not the U.S., where do you put your capital now? Where do you build your next supply chain?
That strategic challenge, that's defining the markets today.
It really is. Definitely a provocative thought for you to chew on as you start your week.
We'll see you all tomorrow morning with new headlines from major financial magazines.